Hello class, welcome to Module 3. This week we're going to be talking about the income statement or the statement of operating activities. So last week we started talking about the balance sheet. And the balance sheet, of course, as you know, is only capturing a single day in time when the assets and liabilities and equity are measured, whereas the income statement covers the whole period from the beginning of the fiscal period to the end of the fiscal period. So it covers a large period of time. So in my opinion, that's a better way to capture how a company performs, better way to capture company performance. So, all right, we're also going to, I'm just going to introduce to you the three main valuation approaches, and that is the asset approach, market approach, and income approach. Asset approach basically is taking the fair market values from either an established market or using appraisals, and then combining those to come up with an aggregate valuation for a company. The market approach uses comparables or either publicly traded companies or past transactions or acquisitions of companies, and it takes multiples, such as market value to or price to sales or price to EBIT, price to EBITDA, and so on. And so those are the two sorts of methods that fall underneath the market approach. The income approach, which is probably the one that I gravitate towards more, and I think most people in finance like to use the income approach as well, just because it's personalized, it's tailored based on the actual revenues and net income with respect to a specific company. So with the income approach, you can either do two things. You can either discount projected cash flows or you can capitalize past cash flows. Now, I prefer to discount projected cash flows just because if you use historical cash flows, you're not going to be able to take into consideration anything that you know is coming, like any regulatory change, anything that you know is coming in the future. You can't really account for it if you just capitalize historical cash flows. So with projected, you can you can modify the revenue projections. You can modify the anything else that modifies net income, and therefore that's the one that I prefer. But in order to use projected cash flows, discount those, you've got to first normalize net income. So this we're going to be talking about normalizing net income. Next week we'll talk about normalizing cash flow. You can use one or the other. I prefer cash flows, normalized cash flow, just because in my mind cash is king, and I don't really care what the income statement says. I want to know what cash is going to be flowing to me. But again, that's my personal preference. So all right, so how do you arrive at normalized net income? What you do is you first start with net income, and then you take certain items and you make adjustments for them. So I've put up just some examples up here in this graphic. So non-recurring items, if there is an item that happened, like an item that is unusual or just non-recurring in general, then you're going to remove that from the projections or from the history if you're capitalizing historical cash flows. Revenue recognition, you want to make an adjustment here if you're comparing to a company that is using, if it's a construction company, it might be using the completed contract method versus the percentage of completion method. Both of those are going to have it's going to give you a different revenue number. So you want to make sure that you're using the same one when you're comparing to other companies. Deferred expenses, are there expenses that have been deferred that should really be recognized now? Interest expense, tax expense. Tax expense is, some companies, they take advantage of tax credits, which could minimize tax expense, or they may pay a lower tax expense, or a lower income tax rate, lower bracket. So these are things that you'd want to factor in when comparing those. Depreciation and amortization. Is your target company using double declining balance? depreciation method versus straight line, because that could have a major impact on your net income, which would then, of course, impact the valuation of the company. So these are all sorts of things that you want to adjust, you want to normalize to put the company that you're looking at to value on a more comparable basis to all of the other companies out there that you're looking at to compare to. Because if you come up with, if you don't make these adjustments and you come up with some sort of wild undervaluation or overvaluation, that's not going to really be helpful to anybody, and you can't compare it to other companies and be confident in it. So that is the target for this week, and I'll see you in the discussion boards. If you have any questions or anything, then as always, get with me, and I'll talk to you then. Have a good week.